Good afternoon, everyone, and thank you very much for joining us for our 2023 Market Outlook. I'm joined by Rob Enslin, a very familiar face. Rob is Director and Portfolio Manager for Linked Investment Managers. My name is Anthony Palmer, Group Commercial Director for Carrick Wealth. The subject today is growth becomes the focus. 2023 has started off with a bang for both Carrick as well as Linked, as well as the markets. We've had a very favorable start to the markets after what can be termed a down year or a very volatile year for 2022. So we're going to cover today what actually happened in 2022. We're going to talk about our outlook for 2023 and really looking forward to the session. We've got lots happening. We've got inflation potentially peaking, the knock-on effect on interest rates. We've got central banks still very much in the limelight, and China reopening. Those are just a few of the topics that we will be discussing today.
Excellent. Thanks very much, Anton. Welcome to all the listeners and viewers. Yeah, I think just to kick off 2022, very eventful year. A lot of things really transpired at the same time, leading to, for investors, a tough year. But I think leading into 2023, and we'll unpack some of those views shortly, certainly a far more broader opportunity set than what we've witnessed for a couple of years. But let's just kick off and start off with 2022. So I think, as we've mentioned, challenging environment. The year started with an inflation shock, which really got going in the fourth quarter of 2021. That led into a quantum and speed of monetary tightening that the world hasn't really witnessed for the prior decade or 4 decades. And one would say that is, in our view, probably the biggest reason for the drawdown that we witnessed in markets. There were some other events that were also equally important. So we saw Russia's invasion of Ukraine, the first time that something of that magnitude has happened on the European continent post-World War II, which really led into an energy crisis in Europe. Thankfully, the winter that Europe's experienced thus far has been a lot milder than years gone by and has somewhat protected people compared to what could have happened. We saw, from a positive perspective, the first time in a decade, positive real yields in fixed income assets, which really hasn't been present for a long time. Saw heightened geopolitical tensions, not only in Russia, Ukraine, but the likes of Taiwan, China, all impacting investor confidence. Big theme that was probably underappreciated throughout 2022 was the extent of China's slowdown, a combination of their property market coming under pressure, and then the second half of the year, the imposing of lockdowns and their zero tolerance towards COVID had a big impact on the world's second biggest economy. And then behind all of that, we were in an environment with an exceptionally strong dollar, which had also a big impact on asset classes, particularly emerging markets. So all in all, a very eventful year. If we take all of those events and sort of put it into one single slide, and the chart just represents calendar returns on the one axis of the bond market and on the other axis of the equity market, going back all the way to 1871. And 2022 is in its own little quiet quadrant at the bottom. So absolutely a devastating year for investors. For your typical balanced portfolio or cautious portfolio that is historically relied on non-equity asset classes like bonds to provide some protection in equity drawdowns, that wasn't present. And so for most multi-asset portfolios, suffering a severe drawdown throughout 2022.
If I can just pause on that for a second, Rob, we speak as financial advisors to our clients, and we really, really run in diversification. And it's times like this where diversification hasn't necessarily worked, where bonds and equities have sold off. And that makes for really uncomfortable conversations with clients, and for clients feeling very uncomfortable. And I think it's pretty clear from this graph that this was an outlier. This 2022 is something that the world has not seen in many, many decades. And interested to hear your view on from this point going on, which we will cover in the rest of today's webinar.
Yeah, I mean, we'll touch on some of those points, but importantly, we need to look at longer-term behavior of asset classes. So 2022, and it's not to say that it's done and won't ever happen again, but 2022 was an outlier year. and to put a portfolio or position a portfolio for an outlier year, for all the normal years, you would have been incorrectly positioned and missed out on returns. So we rely on a long-term view towards portfolio construction. And that certainly goes into our thought process. And in a couple of slides, I'll touch on what those longer-term views of asset classes look like and how they behave. Yeah, so of all of those events that I touched on my first slide, the most significant was really the inflation shock, which led to central banks pivoting towards very aggressive monetary tightening. And the standout was not necessarily that they tightened interest rates. I think we all accepted that we got to a point post-COVID where the amount of stimulus that was pushed through the financial system was excessive, and ultimately that needed to be unwound. But really what caught asset classes and markets off guard was the speed at which that happened. And this is a chart that we've shared, I think, a few times before, but just to reiterate, of those risks, all those events that transpired, the quantum and speed of monetary tightening, we would say, was the most significant in 2022. The chart at the bottom just shows you of the G4 large economies, money supply. You know, it was really accommodative. COVID led to record amounts of money put into the system, and then a sudden turn in direction and a contraction and retraction of money that happened. So take that and look at the chart on the right, and you can just see how different 2022 was to 2021. I'm not going to go through each asset class, but really of the asset classes, only your energy and your cash produced positive returns over that period, whereas many of the other asset classes, which historically and in a normal environment produce real returns, were sharply down throughout 2022. Of all of those, I think the upside surprise of 2022 was the labor market. So by common wisdom would argue that when you put pressure on a financial system through tightening conditions, hiking interest rates, there needs to be a pressure valve, whether that be economic activity and the labor market. And that didn't happen in 2022. The labor market remained pretty robust. If we look at unemployment rates in major economies, the United States by the end of the year netted around 3.7%, Euro area at around 6.5%, UK 3.7%. And a big dynamic that's become very apparent in the labor market is that there are fewer people looking for jobs relative to the number of jobs that are available. So if we look at the US, for example, it's estimated that with around 10.5 million job openings, and only 6 million people looking for employment. Now, this is important going into 2023, because whether we experience a mild or a deeper recession, a large part of that will hinge on the labor market. And if labor is able to remain robust throughout 2023, it is a positive input into a potentially weaker slowdown than what would be the negative or bear case environment. As I mentioned, let's look at longer term asset class behavior. And before we do, just very briefly, of the 12 building block asset classes that we think are important in a global environment, in 2022, 10 of them were negative. So the only two asset classes that achieved positive returns was your physical commodity index, which was up a large amount by 26%, and then being in cash, which reduced to 2%, just shy of 2% return. For the rest, emerging market equities, developed market equities, bonds, even inflation protection securities, they were all negative for 2022. So from a portfolio construction perspective, other than going into cash or going into a heavy or a large weight in physical commodities, the market didn't provide you with much protection. In hindsight, obviously, you look back and you say, well, there was some opportunity there, but importantly, we need to be long-term focused, and we need to construct a portfolio that is well diversified with enough negative correlations or low correlations in it to withstand various outcomes and achieve long-term returns. If we cast our mind to the longer dated side of the equation, you ask the question on, for example, commodities. Over the last 10 years, physical commodities have lost 3.3% per year. Whereas if you take something like equities, developed market equities, it's achieved a return of 8.8% per year, even accounting for the drawdown that we've done. So we're naturally going to be driven towards real return type asset classes. And then the challenge for us is to how much do we tactically adjust based on prevailing conditions to that. And that's the common approach that all of us take in the market. So hopefully that answers your question to some degree.
Yes, thank you.
Moving to the next slide, I think now let's look a little forward and what 2023 may hold, I think is important. I think the sort of environment that we've been over the last decade and also post the financial crisis does feel like it's changed somewhat. And therefore we need to adjust our thought process a little bit, because what's worked in the past is not necessarily going to work in the future in terms of the styles of investments, and also that view of no or very underweight fixed income and very overweight equities are all important considerations. So first and foremost, what is the big picture? Where do we stand right now, and how do we see the world? So I think, yes, 2022 was challenging, and a lot of that sort of damage is still in the minds of many investors, but we need to realize that a large part of that tightening exercise that needed to happen has already now happened, both from an inflation point of view and from an interest rate perspective. It does feel that we've got close to or at the peak of the inflation spike, and therefore probably from an interest rate hiking environment. We're by no means saying that it's over. We still think that we could see some further interest rate hikes. Inflation might sort of move around at these levels, but we would be surprised if there's another leg of acceleration up. In doing that, we also need to realize that this has created some pockets of opportunity, because as much as the market's gone through a downturn, certain asset classes and certain specific investments have been overly punished as a result of it if you compare it to their quality. And therefore, there's an opportunity there. And in our view, the biggest opportunity set that's emerged in the last year has been within the fixed income segment of the market. Our view is that 2023 probably sees the peak of inflation, as I alluded to, and at the same token, the peak of central banks hiking. And then in contrary to that, we probably see the trough in economic activities and corporate earnings. That's our base case environment, and that's how we're thinking about things. And as information becomes available, we will adjust accordingly. For us, more a structural long-term theme is that we think we move back to a more normalized environment compared to 2022, but that normalized environment doesn't look like the prior decade post the financial crisis. We think it looks like a normalized environment pre-2008, where things like valuations matter a lot more as the cost of capital goes up. We think that those days of disregard towards valuation and quality are probably to some degree over, and therefore more traditional approach towards asset allocation and equities, etc., is in play. And as I said, I think the big reason for that is that we're living in an environment with a higher neutral interest rate compared to the prior decade. That filters through to the cost of capital. Money's no longer as cheap as it used to be. And then notwithstanding sort of there are still significant risks that we need to get through from a macro point of view in 2023. We do see a compelling argument for attractive long-term returns for someone with a 3 to 5 year time horizon. Our opportunity set is looking a lot more attractive than what it was just 12 months ago. I made the point about a higher neutral interest rate and living in a pre-2008 environment, and the sort of linkage between that is a structurally higher inflation environment. And there's some points that I just want to touch on the right-hand side, why we think the next couple of years might be an environment of high inflation than what we've gone through. The first and foremost, COVID led to the deglobalization of supply chains. The risk of outsourcing your supply chain to different countries or corporates across the world was challenged during this environment. And what we're witnessing is most corporate countries are almost preferring to reshore or onshore that capability, even though it might cost a little bit more, but for that stability and security that offers. So that, in our view, is an inflationary event. Secondly, the world is transforming to a more decarbonization environment, renewable energies. That requires some input costs, some capital expenditure. We think that's inflationary upfront on nature. Long term, that becomes deflationary, but in the short term, an inflationary event. We've also witnessed, as a result of COVID, again, that sort of power shift back from capital towards labor. So that transforms into higher wages and therefore higher inflation. looser fiscal policies that economies are running across the globe. And then finally, China's reorientation to self-sufficiency. So as the decades have rolled on, China population size, skill set has improved, and the next decade may very well be about China's internal consumption, and therefore less production of cheap goods for the rest of the world. So all those things together, we think are strong ingredients to a potentially higher inflation environment in the next couple of years. What are we paying close attention to in 2023? First and foremost, the path of inflation and therefore central banks' responses. We're not out of the woods there. Whilst inflation has cooled over the last couple of months, it's still in absolute terms at high levels. And central banks' communication to markets remains pretty hawkish. The Fed continues to talk about getting interest rates up to get inflation down. As and when that plays out, we need to pay close attention to that. 2023, in our view, is going to be all about the slowdown in economic activity and corporate earnings. There's some views in the markets that suggest that slowdown might not be as severe as initially expected, and then others expecting deep recessions in the likes of European economies. I think it's fair to say over the last couple of weeks, incoming information from sort of December prints has sort of surprised to the upside, with most economic indicators probably coming ahead, and has created some hope that slowdown, in particular in the US, we might avoid a recession. And I would argue is a part behind the sort of January rally that we've witnessed in the last couple of weeks. Something we also need to think about is, we've hiked interest rates at record pace. What are the second round effects of that? And then sometimes really hits a little later. Things like the housing market with higher mortgages are examples of second round effects we need to pay attention to. China's reopening. The world has a better playbook now as to what that means, that sort of pent-up demand in the economy. Does that lead to higher inflation? What does the Chinese stock market do over that period, bond market, and how sustainable is that over time? And then more subjective sort of things to pay attention to, but certainly we think are still important. US-China relations throughout 2023 and 2024. There's certainly been a tense environment post the Trump administration that hasn't gone away. Does that accelerate in 2023? And then lastly, from a South African perspective, we think the single most important risk to watch is the direction of SA's politics and how that plays out. And then the obvious one is obviously, and we think is linked to that, is Eskom. I'm just going to touch a little bit more on those points. So from a central bank perspective, I think the key takeaway from this slide is that we think central banks will ultimately have to compromise on inflation at the expense of growth. So what that really means in plain language is that we live in an environment with slightly higher inflation and slightly lower growth than what we've just gone through. If we push the inflation agenda too hard and hike interest rates too high, the risk is that we take economic activity too far down. So that's something that's our view. Certainly central banks aren't giving into that view right now. They're pretty clear, but we do think there's a degree of jawboning that's happening there. And ultimately, when push comes to shove, central banks will be forced to make that compromise. From an inflation and a growth perspective, key takeaways, the general consensus is that economic activity slows in 2023 from 2022. As you can see on the charts there, top left, it's forecast that Europe faces a recession for now. There is still some hope that the US may avoid a recession, but it's a touch and go call for at this point in time. And then on the other side of the equation, inflation is expected to come down from this peak. That's consensus view. By all accounts, sort of the second half of this year, inflation is by and large, I wouldn't say under control compared to the past, but certainly not at those peak levels that we've witnessed. The chart on the right is an important one because at the moment, the market and what the Fed is saying are in dislocation. The Fed is still talking about hiking interest rates in the first half of this year to north of 5%, while the markets have gone on to forecast that we actually see some cuts. If history is to go by, don't fight the Fed. It's been something we've all learned over the prior decade and even in this environment. We think that there needs to be some normalization in that regard. I think that the markets may have estimated the degree of the cuts, and at the same token, as I said earlier, the Fed might be holding strong on the inflation rhetoric for now, and there will be compromise from both sides over time. I've spoken positively about the fixed income segment of the market, and we do have a positive view there, but at the same token, there does need to be some degree of caution. I think it's not a blind buy everything that is credit environment. I think credit quality is going to be important in 2023. We prefer the sovereign investment grade side of the fixed income market as opposed to the high yield debt side of the market. The investment grade side of the market, well, that sort of part of corporates' balance sheets are a lot stronger than what they were in 2008, where we think the market is still a little complacent on the high yield side of the market. And should we go into a deeper retracted recession, there's a high degree of vulnerability in some of those high yielding names. So I think that's a key takeaway. Second order effects, I'm going to, just briefly, we've seen in the bottom chart, mortgage rates in developed markets have followed higher interest rates. The way mortgages work in developed markets is that there's a refinancing event that happens every couple of years. And we think that the average consumer will be under pressure when they need to refinance at those higher rates. And that impact, that wealth effect on households is a sort of negative against consumer behavior and therefore markets going forward. On asset prices, this is a positive. Suddenly, generally, most assets are looking far more attractively priced than what they were just a year ago. The biggest relative improvement has been in the fixed income segment of the market. But at the same token, even the equity market as a whole is looking a lot more attractively priced. So we think from a long-term investor perspective, ultimately valuations do matter. And we think an entry point into asset classes now looks a lot better than what it did a year ago. If we take a glance at equities, the big question that we need to pay close attention to will be on corporate earnings. For the last couple of years, the returns in equity markets has largely come from really strong earnings growth. The chart on the right just shows you in prior recessions represented by the blue chart bars, generally speaking, corporate earnings comes down. Now, if we take that with the sort of ramp up in corporate earnings growth that has happened post-COVID, we are looking vulnerable. So we do need corporate earnings to hold up in the next year. Our preference in terms of corporate, if we're looking at the equity asset class, is towards higher quality businesses and managers that invest in higher quality companies with some regard towards valuation. So put that all together, we think quality and value makes a lot of sense. We think that non-profitable growth segment of the market could be very threatened in this type of environment. And then just a little further glance at the various 12 asset building blocks that I spoke about earlier and how they're pricing today. If we look at emerging markets, looking extremely cheap on a price to earnings multiple, one standard deviation below their mean. Same can be said for developed markets. If we look at quality is also very similar picture to developed markets. Growth is at its mean, so it's certainly derated significantly from its highs. It's probably not as cheap as quality and value, the second last chart. And then if we look at dividend yields in the property markets, trading one standard deviation above, suddenly looking a lot more value for money attractive compared to just a year ago. On the fixed income segment of the market, I think this is really what we're saying is that, the pendulum has swung very fast from unattractive yields to suddenly on a risk-adjusted basis, where we're looking at investment grade, sovereign, much broader opportunity set, even cash giving you a better yield than what it's done in the past. And then the other important one, I think, for 2023 is China and emerging markets. Emerging markets have gone through a challenging period, certainly more challenging than developed markets post-COVID. The last year has almost been amplified because of what's happening in the world's second biggest economy being China. As we said earlier, a big part of that was initially a property market crisis that was happening in the economy, followed by an outbreak of COVID that really hit them sort of 12 to 18 months later than the rest of the world. the Chinese approach up front was zero tolerance towards COVID. That sacrifice meant a big slowdown in economic activity, and as a result, Chinese economy almost hit the skids there in terms of economic activity. What has been very encouraging over the last couple of weeks is that it feels like an about turn from the authorities to a far more investor-friendly outlook. The lifting of some of the restrictions, from a corporate standpoint, within the gaming segment as an example, where they've released some new games. They just, it feels as though the momentum is turning more favorably for China, and from an authorities' point of view. We equally have a much better handle of what that reopening looks like, that pent-up demand in that Chinese economy. So all of those things are very positive, and could very well be, particularly the first 6 months, emerging markets outperforming developed markets, remembering that valuations are also more attractive in emerging markets. And we certainly have upgraded our view towards emerging markets after holding a negative view in the last 2 quarters. But we do need to realize that the China economy is maturing. It's not the Chinese economy of the prior decade that was growing at 8% and even prior to that 10%. We think that growth does normalize, and once that valuation unlock plays out, we'll certainly be rethinking about longer term asset allocations towards emerging markets. I mean, those are very theoretical, and we need to, as time plays out, it will be proven. But if that reopening trade is to happen as we expect, that's positive for emerging markets, equities and Chinese equities, commodity links, commodities like copper, and even from an FX perspective, if we see a weakening dollar, that's another tailwind towards emerging markets. We'll pause for 1 second before I lead into the asset allocation views. Anything you want to touch on there?
Rob, very, very thorough. Just one question that I had listening to you was, currencies.
Yeah.
We're all used to volatile emerging market currencies, but we've seen, as you said, massive dollar strength. How do you, as an investor, account for these variances in the different currencies all around the world?
Yeah. So 2022, because of what had happened, it was an extreme environment also for developed market currencies, and the dollar reigned supreme throughout 2022. We saw the dollar strengthen against almost every other currency in the world. A big part of that was the Fed's more aggressive approach to handling inflation. They really got out of the starting blocks a little faster. And as the year played out, that inflation or interest rate differential between the US, for example, and Europe and Asia, like Japan, widened. Coupled with all those risks and the flight to safety towards the dollar, it just made a lot of sense to move your money towards the dollar, the real positive yields there. So that played out throughout 2022. And then there was, on the other side of the equation, we saw the fallout, political fallout in the UK, some drastic changes from an economic policy perspective. So a lot of certainty in the dollar, a lot of uncertainty in other currencies. Europe had its challenges with the war, meant that we had this outsized return in the dollar. I'm certainly not going to try and predict when I think and where it ends, but our base case view is that providing things normalize, we should see the dollar weaken from here on out. We think the environment does stabilize, and with that is a stabilization of the dollar going forward. I think the key is in all of that is always to be well diversified. None of us could have predicted the events of 2022. The same token, there was many arguments as going into 2022 why the dollar could have weakened given their debt on their balance sheet. The complete opposite transpired. So, and that really speaks to the importance of a diversified portfolio. Thank you. All right, so I'm going to lead into more looking forward, how we allocating capital, some of the things we're thinking about, and then I'll provide a sort of a bull case and a bear case to that view. So from an asset allocation consideration, these are things that our team are thinking about, not necessarily implementing in all of our decisions, but we see them as potential or future risks in our portfolio construction. First and foremost, our base case is that the world does slow, and that slowdown is more pronounced in developed markets, particularly Europe in 2023. Secondly, you may have not heard of the term TINA, but what it stands for is there's no alternative to equities, and that's been the trade of the last decade up until even last year, really, where equities were just looking so much more relatively attractive dealing with higher growth, higher inflation, all those types of things were on the side of equities. We think because of what's happened in the last year, that normalization back to pre-2008 environment looks a lot more set. Fixed income has closed that gap, so that we think that TINA trade is now behind us, and we're thinking that there's some other opportunity sets in equities to consider. Sort of leading into that other opportunity set is the fixed income side. For the first time in a decade, we're actually getting positive real yields. So if you account for inflation, you're still making a return in the fixed income segment of the market. Now that's important for fixed income, but it's also important for other asset classes. We think that quality and value matters a lot more than what it's done prior to compared to the last decade. We also think that old industries that have been neglected and not enough capital expenditure has gone to them over the last couple of years probably looks attractive again. So beneficiaries of that would be industrials, consumer staples, banks even, and even energy stocks that we've witnessed have performed quite strongly over that period. All said, if that environment and that backdrop that we've spoken about, higher neutral interest rates holds slightly higher inflation, then value should probably continue to outperform growth in the next year. If we move into a weaker economic environment than we're forecasting and central banks lead to sort of a cutting environment, then that view might change a little bit more back in favor of growth. At the same token, we know based on prior recoveries, because we do need to start thinking post or after slowdown, what happens is that value and small caps tend to outperform growth and large cap stocks. Some of the market catalysts that could drive markets higher in 2023, China's reopening, the weakening US dollar, which we touched on, onshoring and reshoring, and that creating some demand in certain industries. And then the important one is cheaper valuations. Ultimately, prices follow valuations, and we know that valuations are looking a lot more attractive than what they were 12 months ago. And then the blue sky would be some form of resolution between Russia and Ukraine. These are catalysts that we think are known knowns or known unknowns at this point in time. The unknown ones are the more difficult ones and the ones we'll need to deal with as they play out in the year. And then notwithstanding the derating that we saw, we think a large part of that is behind us in 2022. There are still some significant macro risks that we need to get through this year. Some of those we've touched on, the slowing economic environment that we're entering into, slowdown in corporate earnings. So whilst we see an attractive opportunity set, if we take that against the risks, we think a measured approach is always the sensible approach, and we think this environment is equally important to have that measured approach in terms of investment decision making, but certainly from our side in terms of how we're constructing portfolios. So with that, I'm just going to quickly take you through our base case portfolio construction. What we're looking at is a typical global portfolio here, a balanced portfolio. You'll see that we've outlined what our long-term strategic asset allocation view is. For example, emerging markets, we would hold equities at around 5%, developed market equities around 58%, developed market property at around 5%, inflation protection at around 5%, cash at 5%, and then the balance going to a fixed income, a basket of a combination of government bonds, investment grade bonds, and emerging market bonds. If we take that view and how going into this year we want to be tilted under or overweight, we're neutral on emerging markets. We appreciate the valuation set and the opportunity that, for example, China presents itself. We've been underweight, so that's actually a slight upgrade from being underweight to neutral. But we also need to pair that off against the potential risk that brings over time. So hence the neutral view. It's a more favorable view than the developed market side of the equation. In the developed markets, we're marginally underweight. We think that we prefer that slight underweight if based on our view that we go into an economic slowdown. For similar reasons, we underweight listed property. We think higher interest rates, slower economic activity are significant headwinds for the overall property segment of the market. There are some pockets and segments that still will be beneficiaries, but as a collective, we're underweight. The big adjustment for the outlook for 2023 is we've upgraded our view on fixed income across the board. So we hold a neutral view towards sovereign bonds. We actually marginally weight investment grade debt, touched on why we thought balance sheets were strong enough to weather an economic slowdown. and then we're slightly underweight emerging market bonds still at this stage. But if we take bonds as an overall, that's a big upgrade. Inflation protection, we hold a zero strategic view on commodities, and we're holding an underweight view there. Inflation is not necessarily gone, and the risks are still there, so we're still neutral on inflation protected securities, and we hold a slightly overweight view on cash. We think that's a nice offset that provides us with a better yield than it's done in the past, and some optionality should things sort of translate into weaker or sell-offs. We have that ability to redeploy that capital. And then finally, from my side, just that's the base case. What are some of the upside and downside risks to that view? From an upside perspective, inflation as a starting point. If inflation turns out to roll over faster than what we're all expecting, there would be upside. Corporate earnings holds up stronger than we anticipated. From a real estate perspective, we're all expecting a slowdown there. If real estate actually holds up a bit better, that wealth effect would be important in our view, and therefore an upside. Supply chain delays, cool. We're still living in an environment that supply chains are constrained. They certainly improved over the last couple of years, but they're not back to normal. If we can see some stability there with the Chinese reopening, that would be a deflationary event, but also overall an improvement in economic activity. The dollar falls sharper than what we anticipated. That would be an underpin, particularly for emerging markets. And then more workers return to the workforce than what we're forecasting. On the other side, some of the downside risks is that central banks remain solely focused on inflation. In doing so, fighting inflation completely kill economic growth. There would be a downside risk. China's reopening translates into high inflation. We haven't had that discussion enough yet in the market, but that's certainly something we've seen what reopenings do to inflation in the developed market. Does that create a second round effect of inflation across the globe? The Ukrainian war broadens on the European continent. And then lastly, the second round effects of a mortgage shock on the property market and the wealth effect that causes. So these are the things we're thinking about. Certainly a fluid environment we're still living in. But to reiterate, takeaways as an investor, a balanced or moderate view we think is important, notwithstanding that we believe that there's compelling opportunity set in most asset classes for those taking a 5-year time horizon. So with that, I'm going to stop there, Ant, and happy to field any questions.
Thank you, Rob. Sure, we've got lots of questions coming in, but in the interest of time, I think we need to start wrapping up. I'm just going to choose one question, and I've chosen it because it's the shortest one, but it really is around the topic of why you have zero commodities in the portfolios when we've seen such big increases in commodity prices over the last couple of years.
Yeah, so I suppose the question's been raised a lot because of what happened in 2022. Commodities was really the only show in town, the only way to have protected portfolios other than being in cash. And the starting point is really to look at long-term trends of assets and how they behave in isolation, but also how they behave in relation to one another. And if we take that view over the long period, physical commodities, as I showed earlier, has actually been value destructive in portfolio construction. So for us, it would need to be a tactical view and a very strong tactical view as to increase our weighting towards commodities. But if we look at where we're at right now, we think inflation has peaked. We're going into a weaker economic environment. If we take all of those things collectively, we don't have a strong conviction to still hold commodities. Protection, we think, is better served in cash and even in the fixed income side of the portfolio.
Perfect. Thank you very much. Let's end it there for today. I mean, my takeaways, there's certainly pockets of opportunities. You want to stay invested throughout these cycles. You don't want to miss those up days. We've seen some significant up days this year, and long may those last, but you certainly want to stay invested for the long term. And for all of you that have dialed in, again, thank you very, very much for your time. If you have any questions, please reach out to your Carrick advisor. And Rob, thanks again for your valuable insight. And we look forward to seeing everyone at our next webinar. Thank you very much.